All right, so guys, we've got the war in Israel. We've got the war in Israel affecting the markets right now. This is the mood. These are the talking points right now. These are the things that are affecting the financial assets that we're trading right now. We've got the war between Iran and Israel escalating. We've got interest rate uncertainty since we've gotten that. And then we've also got inflation. And a good labor market. These are the things currently, guys, that are affecting financial assets and the strength of the dollar. So I'm going to go in order and tell you why we've been seeing this rise in this dollar. All right. This move that we're seeing in the US dollar, the strength in the USD is mainly because of the fact that we are here in the narrative. Markets are fully pricing in that the next time that the Federal Reserve meets to discuss whether they're going to be cutting interest rates or not, it is likely that they're going to give us 25 basis points or 0.25% of an interest rate cut. Now, while that may in the long term weaken the dollar, in the short term, it has proven to strengthen the dollar because the markets were aggressively expecting a 50 basis point aggressive move, another one. Remember last time we had FOMC, gentlemen, we got a big fat 50 basis point cut. Remember, and that weakened the dollar, and it was a buy on the Euro USD, GBP USD, gold went to the moon. You guys remember? This was a few weeks ago. Yes, no, maybe. Can anybody confirm or deny?
Yes.
No, no, me, I wasn't looking at the markets then.
All right, have you been reading the articles though? Because I mean, I've been updating all of this.
So then, Mr. Macy, can I ask a question?
Yeah, go for it.
So then if we had a 25 basis point cut, would we have seen a sell-off in Euro USD, GBP USD, and all that?
I really think so because that's actually a great question. Superb question. Shout out to you for that. I thought my view was that we would get a 25. Remember the articles that I've been sending to you guys? We've been talking about a 25, thinking that we're going to get a quarter point reduction, same as we got in SA, right? Had we gotten a quarter point reduction, I believe that this upside move would have happened, but sooner. It would have happened at the point where I think FOMC was on the 18th of September, if I'm not mistaken. Yes, it was here. That spike down below here. So that spike weakened the dollar substantially to the 100.222 level. All right. And as you can see, we failed to break that level all three times. All right. So I believe that that buy side pressure would have happened a lot sooner. It would have happened here. And we've had that breakout there in anticipation of a 25 basis point interest rate cut. Now, the reason why this would have been positive for the dollar is because markets have been aggressively pricing in a 50 basis point interest rate cut. And that is because of the recession fears in the USA. You remember we got that very, very low NFP figure recently, I think last month or last of last month. You guys remember that?
Yes, yes.
All right, now let's check it out. Let's actually look at the data. Let's look at the data. We're looking at NFP, right? We're looking at the jobs figures. That was actually a great question. The only condition that would have given us, when was NFP? Where are we right now? We're on the 9th, right? We're looking for last week, Friday. That's the 4th. Okay, let's look at the data because the data will tell us why the chart has been behaving the way it has. Okay, and that is our job. That's all we need to know, basically. Look at non-farm payrolls. Let's look at the figures. Let's just let this chart load. Okay, there we go. Let's look at these figures just for this year. Just for this year alone. March. All right, there we go. Immediately, what stands out to your eyes, guys, when you look at these figures? Look at August. Early on in the year, the US economy was adding around 250,000 jobs a month in that month, quarter mil. April was our best month for the labor market this year. We added just above 300,000 jobs. All right. Then it moderated. As you can see, this is a chart. Then it moderated. We had that drop in May where we added about slightly just above 150. All right. Then we had that spike up in June where we added slightly above 200,000 jobs. Then went on to July when we dipped below the 200K mark. And this, gentlemen, was the point at which those recession fears came into the markets. And that's when the markets aggressively priced in that the Fed would drop interest rates aggressively to try and prevent the labor market from causing a recession. Because, guys, remember, any economy is driven by how many people are employed. All right. The more people employed, the more people have a salary. The more people have a salary, the more people are spending it, and that increases consumer spending, which then increases retail sales, which then increases GDP, which then increases this currency value. All right. Can you see where I'm going with this? But too much of that causes inflation. All right. So where we are in the narrative is that when we got that dip below 100,000 jobs, representing the lowest figure this year, markets thought that the Fed would begin cutting interest rates, all right, and aggressively by 50 basis points, which is what we got. Okay. Now, that in theory should have weakened the US dollar. Okay. And it did just a little bit. I just want to show you guys. We can check it. It's right there. Let me just find it. Right here. That spike down below. And again, guys, look at the level. Look at that level. Very, very important. That weakened the dollar towards the low of the year. If I zoom out of this chart and we look at this chart in its entirety, which I probably should be doing, we'll see that this is the low of the year. Let me clear all these drawings here. Yeah, let's clear all these drawings and try fill it in. All right, so that's the level. This is 2024, guys. Can you see that the low of the year was actually here? This is January, the beginning of the year, and that's the lowest or the weakest that the US dollar has been, gentlemen. Can you see how significant this level that we were at is? This was the lowest level, guys, right there. So can you see where we were trading once we got that 50 basis point priced in because of the lower NFP? It weakened the dollar to levels not seen this year. And therefore, this upward move that we're seeing over there, it makes sense to have happened because of the demand that would have been placed at that level. It represents a major discount in relation to where the dollar has been trading for the whole year. Can you guys agree or disagree with that? Hello, guys. Can you hear me?
Yes,
I can
please.
hear you loud and clear, sir.
Loud and clear. All right. Do you guys follow where I am though? In terms of what I'm trying to describe to you, in as far as what is affecting the relative strength of the dollar that we're seeing right now. Can you see what's been affecting it? That's been the trade. So we're at the low of the year. We've just come from that historically low NFP where we got that 89,000. All right.
Well,
That's a,
since since
I'm listening. Hello? All right. So anyway, let me just draw.
yes, King, I wanted.
Bro, I can't hear you. Your network is really, really bad.
Sorry. I want.
Okay, so I'm just gonna let me just make the point I want to make now. So if you guys can see the trend that we're seeing in the jobs data, all right, at the point where the alarm bells were ringing, um, that's where the market's priced in aggressively, that the Fed would drop interest rates aggressively, and that would weaken the dollar, and risk assets would begin to rally. That whole thinking and thought process did happen, but it got derailed because after this happened, the markets were anticipating that perhaps the trend would keep going down lower, which would then necessitate even more interest rate cuts, which would then make gold go higher, Euro USD go higher, GBP USD go higher, Bitcoin go higher, NASDAQ go higher, DAX go higher, US 30 go higher. Basically, talking all risk assets across the board. But instead of that, we saw some strength begin to pick up in the labor market, all right? September's jobs numbers were decent. They moderated back up above 150K, all right, showing that the labor market is still somewhat resilient. The jobs report that we got last week, Friday, of 250 guys, look at what it represents. It is basically the third highest in as far as the whole data set for the year goes, which says to the markets and the labor market as well. I mean, not the labor market, which says to investors, investors, the market, as well as the Fed, that number one, the labor market is healthy, jobs are secure, the economy is adding jobs at a decent pace, okay, which is one of their dual mandates. And if that is happening, that doesn't mean that they need to drop interest rates aggressively. And that's why, gentlemen, you are seeing this big rally on the US dollar index. All right. This upward move that we're all seeing right now. This move bouncing from this level all the way to the high. What we're seeing is the expectation that interest rates are going to stay slightly higher for longer because the labor market is healthy, a recession is not coming, and inflation is making its way down to 2%. So there is no need to drop interest rates aggressively because the labor market is fine. All right. An aggressive interest rate cut is just going to stimulate the economy. And if so, I want you guys to understand this now. Interest rates are like gravity. When they go up, everything else goes down, including consumer spending, including investments, including the housing market, including people's spending appetites, because they have less money, disposable income to spend at the end of the month, right? So now we're going into an environment where interest rates are coming down, which is going to stimulate the economy. Now, if it stimulates the economy, it's going to cause more jobs. More jobs create more salaries, more consumer spending, higher retail sales, higher GDP, and that could cause more inflation. So it doesn't make sense to drop interest rates aggressively again into that kind of environment that is already seeing so much growth and resilience. It's reflected in the jobs numbers. Can you guys see what I'm trying to explain? And that's why you're seeing the dollar rally in the short term right now. And the expectation, in my view, is for a move back down right from there. I think that tomorrow, if CPI gives us, if CPI gives us, let me just find this equation in my mind. The inflation data that we're looking at this week is really going to be critical because we've already seen off the labor data. The labor data is saying to us and the Fed, the decision makers about interest rates, that the labor market is healthy. If the labor market is healthy, in our equation, it could potentially cause inflationary pressures because inflation has been coming down. However, we're sitting at a point where we've got the war happening in Israel, all right, between Hamas as well as Iran. The price of oil has spiked from $70 a barrel towards $80 a barrel. We know that when the price of oil goes up, the unintended consequence is inflation. Okay. So it doesn't make sense to drop interest rates aggressively because that will create more consumer spending, which will create more inflation. We've also got the wars happening. Dropping interest rates in that kind of risky environment also doesn't make sense. So people are pricing in that the Fed is unlikely to give us a big interest rate cut, which is positive for the US dollar. And that means it's a sell right now for Euro USD, GBP USD, gold, risk assets across the board. Of course, there are nuances in as far as technical analysis is concerned, but broadly speaking, guys, we can see we've got dollar strength. So what I'm trying to say in closing is that if we get lower inflationary data tomorrow, right? Let's look at the data. Let's look at the data quickly. Right, this week. Let's look at the data real quick. This is going to make sense. I'm going to tie it up and make sense of everything real quick. So we've got CPI on Thursday, guys. Look at the expectation. All right. The previous figure, 2.5%, we're expected to moderate towards 2.3%. If that happens, guys, then this equation that I just drew up here makes sense. All right. For the dollar to come back up to this previous lower high, you see this level, there's rejection. Dollar to come back to that previous lower high, we can draw a trend line there. Once we get that breakout right there, and maybe sort of like a retest before price tanks, then we can buy everything else across the board. We can buy Euro USD, we can buy GBP USD, we can buy gold, all right? We can buy NASDAQ, we can buy Dow Jones. It's a buy across the board. We'd be selling something like USD CAT. We'd be selling something like USD ZAR. Do you guys understand what I mean? Because if inflation is coming back down and jobs are good, then they can keep cutting interest rates because inflation is coming down. But if inflation proves to be above that figure that I just said, if we're sitting at 2.5% previous and maybe we go back up to 2.6, 2.7%, then I bet your bottom dollar, we're gonna see the dollar break up above, guys, up above because interest rates will definitely stay higher for longer. Instead of debating whether we're going to get a 50 basis point or a quarter basis point rate cut, we might not even get any interest rate cut at all, which would be positive for the dollar, and then we'd see everything else take a shit. Do you guys understand? I think that's as best as I can explain it.
Yes.
Understood.
Understood. Nah. So if you guys do your technical analysis now and you look at something like gold or Euro USD or GBP USD, actually, let me just open a chart. We should start seeing buy side setups. Okay, so we should plan for what a buy side setup would look like and what a sell side setup would look like. And then once we see the data, we can decide which direction is going to hold long term. If we get lower inflation data, it's a buy. If we get higher inflation data, it's a sell. You guys understand? What I'll do is, it's actually in the article, guys. I don't even need, I was about
So
to say, yeah, yeah, let's go for it. I'm listening.
this one, like if you can jot down for us, let's say for example CPI. If CPI is going to be higher, we're expecting a buy. If CPI is expected to be lower, we're expecting a sell, like a formula sort of kind of thing. You understand?
That is literally in the article, guys. This is how I can see that you guys don't read. That shit is in the article, guys. It's right there. I'm actually gonna find it right now. Ne? I'm gonna find it, guys, and I'm gonna be so upset right now if I find it. Let me share my screen. Let me share my screen. Because guys, I tell you all the time that I put the stuff in the article for you. That formula that you're looking for, it's literally in the article. So here's the article that I just sent into the group today, all right? We're seeing a 7-week high in the dollar. Now let's look at the implications. Jobs reports shifts rate cut expectations. That's exactly what we just unpacked. Okay, implications on the Fed meeting next week. All right. Who asked that question? I didn't get to see. Who asked that question? I'm really, really curious. Ha, here we go. If the CPI and PPI data this week reveal higher than expected inflation, it could justify a less aggressive stance from the Fed, potentially resulting in a smaller or more gradual rate cut. On the opposite side, if inflation appears to be cooling or coming down, it's going to grant the Fed more flexibility to pursue even more interest rate cuts, which will then support the you can see the growth and the global tensions and the market volatility increase as well. So you can see it's right there, guys. The formula is right there. I don't know if it makes sense. Maybe the English is the problem.
Oh, yeah, verse 8, some of us say.
Can you see there? That
It's
portion that
the
I just
English.
highlighted.
It's the English.
It's the English, no?
Yeah.
Yeah.
But having explained it, can you guys now see that it's the answer is to that question is in the article.
Mm.
It's right there. I mean, maybe you guys didn't understand at first glance, but that's why I say that the more we read these articles, guys, the more you'll get used to this language and this jargon because there's no easier way of putting this anymore. Like there's no difficult words in there, guys. There's no difficult words in there. It's just about getting used to the jargon and the formula. The formula's there. If we get higher inflation, you need to think about what that means for interest rates. Right. Higher inflation. Let me just write it down actually in short. Let's write it down. Higher inflation equals higher interest rates for longer, which equals strong dollar, which equals sell. Simple as that. Lower
Yeah, so you see,
inflation.
with the way
Yes, sir.
you see this explanation makes sense now, you see.
Oh, okay,
Rather, this
okay.
formula,
This formula,
yes,
nah.
it's
Okay, you
much
just needed
better.
it
Yeah,
broken down, vele, nah. Okay, dad, don't stress. I know these
yeah.
things can be complicated, but I think once you've got the formula understood in your mind,
Then
you know,
reading the
like,
article will be
then
easier.
becomes easier. Okay, I understand now.
Yeah,
Okay,
yeah,
so
yeah,
let's go
yeah,
through
yeah.
lower inflation. Lower inflation will mean that, what does that mean? We look
Low.
at the low inflation, we've got good jobs, we've got lower inflation, the job is nearly done. What does that mean? We can keep cutting interest rates, right?
Yes. Lower interest rates.
Yes, lower interest
It
rates.
weakens the dollar.
Sorry, and that's weak for
It
the dollar,
weakens
right?
the dollar.
Yes,
Yeah.
weak dollar. I love it. Next,
Then you buy.
buy GBP USD, buy gold.
Yes.
Yes, it's as simple as that, gentlemen. So, with these new fresh eyes and ears, I implore you, let's read the article tonight before you go to bed. I promise you it'll make more sense now.
A quick question, King. Angazi noma izoba relative to lento lena yabo.
Yeah?
So at the current place for interest rate, like where interest rates are at right now, would you consider them as high interest rates? They're high.
Yeah. Yeah. In the past, okay, so here's great question. And here's perspective. In the past 21 years in the United States, 5.5% is the highest, right? And we've just came from that 3 weeks ago. Before the Fed cut by 50 basis points last month, that interest rate of
Mm-hmm.
5.5% represented a 2-decade high for the USA. So if you had a
Okay,
s-
okay,
so so
okay.
if so if you had a savings account, that was the best time to have a savings account. That was the best time to lock in investments that are linked to interest rates. That was the best time to be in credit, not in credit, but in cash type of investments. All right. So high interest rates are great for people who have cash on hand, who can lend it to other financial institutions to work with. But high interest rates are bad for people who have credit, like installment on a house, on a bond, installment on a car, because if that's linked to the interest rate, the higher the interest rate goes, the higher your installment goes every month as well, which leaves less money in your pocket and thus slows down the economy and brings down inflation. And once inflation comes down, then interest rates can start coming down, which is where we are right now, which will then weaken the dollar. And we're then looking to either buy the risk assets. However, we need to wait for the data and then combine it with the technical analysis. So what are we seeing? Let's try maybe look at a I've got 6 minutes left, guys. Let's look at a chart. Let's look at something like a GBP USD. No, let's look at gold. Let's look at gold actually. Let's look at gold on the daily. I can bet my bottom dollar we're sitting at a support. Just ready to buy. All right. Let's delete all of that. Let's delete everything. All right. I can bet you guys we're sitting on a support. I haven't traded in the past week, but I can bet you. So immediately context, trend line. All right. We need to connect the three most
There is
recent
no
higher
picture
lows.
on my
Oh, there's no
side,
picture.
King. So I
There's
said
no picture. Oh,
yeah.
okay. Okay, cool, cool. Thank you for that. Let's go to Zoom. I'm sorry. No, one. Share. All right, let's look at gold. All right, so gold, we're gonna go on the 4-hour chart, and immediately what you can clearly see, just by connecting the first three higher lows. One, two, three. Look how perfect that is, guys. So markets are forward looking. I always say this, guys. Markets buy the rumor and sell the fact. By the time interest rates are cut, or by the time the inflation data drops, sometimes it's too late to have entered the trade. The chart will already made a movement like this. So maybe the first bounce is there, then we might get a boom, boom, boom. Tomorrow CPI, bah, it explodes. So this is what I mean that that level already is showing signs of being respected going into CPI. So it's giving us clues already that tomorrow's CPI could potentially be a buy. The technical analysis is confirming what the fundamental analysis is saying. So now if we look at the next high in the range, so we had a range over there. And if we take the high of that wick and project outwards, it gives us the current price action. It gives us the current price action beautifully. Can you guys see that?
Mm.
There's nothing much more to say here, guys. This is as clear as daylight. Okay. Now it's just about waiting for the data. Now it's just about waiting for the data because we can clearly see it. Textbook stuff. Previous resistance has now flipped and it has become our new support. And we've got this trend line that's being supported on the 4-hour by the buy side liquidity. This is also a zone of support.
So then, Mr. Waisi, I
Yes,
have a
yes,
question.
yes.
Um, wouldn't due to the fact that we got a higher NFP, wouldn't that increase inflation CPI tomorrow?
It would. That's a great way to understand this equation. It would. And therefore, we must prepare for the sell side scenario. So the sell side scenario is as such. If we get that higher inflation, then we likely get that same bounce. We likely get that same bounce. Boom, boom, boom. Then tomorrow, boom. The first initial move when CPI breaks will flush out that zone, create a new low, and then 15, 30 minutes later, or around 3:30, we come back, we retest this level, bam, Bob's your uncle. So we know what to do. We sell the retest if we get that higher inflationary data, because that'll mean higher interest rates for longer, weaker gold, bullish on the dollar. Great question. Superb question, bro.
Perfect.
All right. Understood, right? We've got the mandate. We know exactly what to do, guys. If we get good news, inflation is coming down, we know exactly what to do. It's a buy. If inflation is still high, we look for the structural evidence of that, and then we sell on the opposite side. Okay?
All right.
All right. Good evening, and I will see you guys later on this week. That was a great session. I'll send the video in the group.
Thank you so much.
All right. Cheers, gents.
Hola.
Cheers. Have a good evening.
Thank you,
Yes,
sir.
okay.
Shop, shop.
Lekker.